A semiconductor cough rattled through the tech sector today as SMH shed 3.11%. And the question is whether this is a fever or a cardiac event brewing in the broader AI trade. The Dow surged over 1%, while Nasdaq stumbled, signaling capital rotation from speculative growth into industrial fundamentals. Every dollar that left semiconductors found its way into value stocks, creating the cleanest sector divergence of the week so far. Greed is running hot on consumer discretionary but cooling in AI infrastructure. XLY posted a 1.53% gain as retail and travel spending continues to outperform expectations, while MAGs climbed only 0.6% despite heavy earnings activity. The Magnificent Seven are showing selective strength. Meta's post-earnings dip remains limited according to Goldman's models. And Tesla could nearly double from current prices within a reasonable time frame given automotive inventory corrections. Capital is no longer indiscriminately chasing AI. It's picking winners and losers with surgical precision. Credit conditions are stabilizing after midweek volatility, but regional banks remain the primary barometer of stress. Canary surged 1.63% as commercial real estate exposure fears receded overnight. The 10-year Treasury Yield dipped to 4.6%, down 0.8 basis points, confirming that institutional money is pricing in slower GDP growth rather than a hard landing. Invesco's earnings call highlighted tighter lending standards across enterprise software acquisitions. Banks are becoming gatekeepers of AI infrastructure financing. Fear is cooling across the board as UVXY dropped 1.4% and VXX shed nearly 1%, indicating short volatility positions are unloading profit. The Nasdaq's 0.22% move created a false breakout below key technical support at 24,800. But volume profiles show institutional buyers absorbing selling pressure rather than panic capitulation. Exchange-traded funds rose despite mixed futures because the Russell 2000 index gained 1.2%, confirming that smaller cap liquidity is returning after 2 weeks of compression. The real economy is splitting into AI beneficiaries and infrastructure laggards. A Goldman economist estimates meaningful economic impact from AI won't materialize for 15 years, but Tesla's automotive segment, already priced at a 60% premium to peers, could see double-digit gains if production ramp-up accelerates in Q3. Boeing jumped 6% as defense contracts offset commercial aviation headwinds, while Coca-Cola gained 4% as consumer staples become the new AI proxy. This is what happens when valuation discipline meets earnings reality. Safety assets are showing selective strength with XLP leading at 2.09% and TLT up 0.65%, but GLD retreated 1.15% as gold's role as a safe haven becomes contested. The bond ETF gained 0.29% while high dividends declined, suggesting investors prefer growth at a reasonable price over pure yield. Utilities are the true defensive play right now. XLP's outperformance signals that dividend aristocrats with regulated cash flows are replacing gold in institutional portfolios seeking predictable returns. The portfolio is fighting a dual-front war: AI valuation compression and credit tightening. SMH's 3.11% decline exposed semiconductor inventory overhang, while Canary's +1.63% rally confirmed regional banking resilience, despite commercial real estate concerns. The Dow Jones divergence, Dow up 1.03%, Nasdaq down 0.22%, is the clearest signal. Capital is fleeing speculative tech and flocking to industrial fundamentals with visible cash flows. The hero portfolio survives by rotating out of overextended AI infrastructure, plays into defensive sectors with pricing power, but the villain, valuation risk, remains active in any position that hasn't corrected at least 15% from recent highs. The Canary dashboard shows a portfolio under stress, but not on life support. SMH's cooling is temporary, as Q3 earnings clarify which semiconductor winners will survive margin pressure and the Dow Jones divergence suggests smart money has already identified the rotation into value. Watch for tech sector confirmation at 7,400 on the S&P. If that holds with volume, the fear gauge reset may be complete. The data is screaming, patience beats panic in a market this volatile.